Hello, everybody, and welcome to my intermediate 17th edition video solution walkthrough for problem 14.8. The textbook authors of the 17th edition from Wiley are Don Kiso, Jerry Weingant, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not myself, not the authors of the textbook or Wiley. Always fun to talk about yourself in the third person. Okay, that Bennett is terrible. Okay, so right over here. So problem 14-8. On December 31st, 2020, Fidel Corporation acquired a computer from Plato Corporation by issuing a $600,000 zero interest bearing note payable in full on December 31st, 2024. Fidel Companies, I'm not saying it right, Fidel Companies credit rating permits it to borrow funds from its credit line, several lines of credit at 10%. The computer is expected to have a 5-year life and a $70,000 salvage value. So prepare the journal entry for the purchase on December 31st, 2020. Well, the first thing we know is that we're going to be having over here, so we're going to have 2021, 2022, 2023, and 2024. So this is when the corporation is going to have to pay back basically the zero. This is when the corporation is going to have to pay back the amount in full. So $600,000 4 years from now is not the same as $600,000 today. So what we need to do is we need to bring that back to today's value. So the note payable, zero interest bearing, is $600,000. So to bring this back to today, I'm going to use the present value of $1. I'm going to use 4 periods at 10%. Okay, present value of $1, 4 periods at 10% is 0.68301. So when I bring that over here to this one over here, the present value of this today is going to be 409,806. So when I purchase this equipment, what I'm going to do is I'm going to, on 12/31/20, I'm going to debit equipment for 409,806. I'm going to be crediting note payable for 600,000, and then I'm going to debit discount on notes payable. Just because it's zero interest bearing, it means the interest is implicit, or implied. So the amount of my discount is going to be the difference between my note payable and then the present value of that note payable, or 190, 194 to record purchase of equipment. Okay, so right over here, prepare the journal entry for the purchase. Prepare any necessary adjusting entries relative to depreciation, use straight line, and amortization on December 31st, 2021. Let's do the depreciation first. So my straight line is my acquisition cost minus my salvage value divided by my estimated useful life. My estimated useful life for this is 5 years. Okay, so this is 5. My acquisition cost is 409,806 minus 70,000. I divide that by 5, and I get the total of 67,961. So my depreciation expense, straight line, so I'm going to do the same amount every single year, 67,961. I'm going to have accumulated depreciation on equipment, 67,961. This is going to be to record depreciation expense. So the next thing I'm asked to do over here is adjusting to amortization. So right over here, how do I go through and I amortize this? Well, what we're going to go through and do is we're going to have over here our note payable. The face value of it is 600,000. And if I look at this in terms of T accounts, right, what is it that I'm going to try to want to go through and have happen? Well, what I want to try to see have happen is I've got this note payable of 600,000, and then I have a discount on notes payable. My goal is I want this this discount on notes payable by the end of the 4th year to go down to 0. So what I'm going to do is I'm going to amortize it by using the effective interest method, which means what? I'm going to take on 12/31/21, my note payable is 600,000, less my discount on notes payable, which is 190, 194. My notes payable carrying value is right over here at 409,806. My interest rate is at 10%. So my interest expense is going to be 409,806 times 10%, or 40,980.60. Now, what happens is when I record the journal entry on 12/31/21, I'm going to debit interest expense. I'm going to credit discount on notes payable. So right over here, this is for 40,980.60, and this is to record interest expense. So once I have this part down over here, my next step is I'm going to be at 12/31/22. My note payable is still going to be at 600,000, but after this first year, I've gone through and I've amortized it by 40,960.86. So my new discount on notes payable, or my new carrying value after the first year, is going to be 149,213.40. So if I go through and I kind of follow along over here, so that's going to be my interest expense or my discount amortization, 12/31/23, same note payable amount. My discount amount though now is going to be 104,134. My carrying value is 495, so it's slowly inching up over here. And then I got 12/31/24, 600,000. Okay, so if I take this through and I go through and finish amortizing it in each of the years by debiting interest expense, and I go ahead and I credit. So this would be 12/31/22, 12/31/23, and 12/31/24. By the time I've gone through and amortized these parts, what I'm going to end up with is my ending balance should be close to pretty much about 0, or about $3. So I would just go ahead and round it up. But that's how I know I've done this question correctly. So any adjusting entries relative to depreciation and amortization, well, we can, what's great now is I can just go ahead and copy, because we've kind of already done it. So the format for the journal entries isn't really going to be changing here. So my depreciation expense, because I'm using straight line on 12/31/22, and my interest expense. So over here, my interest expense is going to be the amount that I amortize this by, or 45,078.86. And I know that's correct because by the end of the time through the amortization of this note payable, I know that by the end of it, it's going to be coming down to like $3. So that is problem 14-8. I hope you enjoyed this here today, and I look forward to seeing you on the next video. Have a great one, and I want to give a shout out and a thank you to Wiley for allowing me to use their videos and publish these. Please don't forget to like and subscribe if you'd like to see other solutions. Please feel free to ask for in the comments.